Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by Bull Realty. It is my company for customized asset and occupancy solutions. Visit bullrealty.com or contact me directly at michael@bullrealty.com. Well, I'm excited about the show today. One of my favorite guests of all time is here is KC Conway, Red Shoe Economist. He's also the CCIM Economist and joining us here in Studio One. KC, great to see you.
Thanks, Michael. Always be glad to be back with you.
Thank you. And I think everyone's interested to hear your view on the economy and real estate and what's going on. It's been kind of a crazy time. Here we are in November of 2022. And I guess since March, we've had, 3 3/4 increase in the Fed's rate?
Yeah, and had 4 of them in a row.
In a very short period of time. And it's really in creating some pricing discovery and some really tough planning, I guess, moving ahead for lenders and investors and equity out there. What do you expect for what we have? The Fed meets in December. What's the expectation there?
I think we'll get another 75 basis point increase, and the best hope is maybe in early next year they start to slow it to maybe 50 basis point, but they're in a rate hike mode, I think, well into at least mid to late next year. But I think we get another 75 basis points.
You were at the Fed at one point, and as an economist, what do you think about it being moved this quickly? Don't these rate hikes need some time to really take effect on the economy?
Absolutely. And I think, Jim Bullard at the St. Louis Fed and Esther George at the Kansas City Fed have really been saying that you need to pause to understand, kind of what you did. It's kind of like when you're cooking something on the stove, you need to take a taste test. They forgot to take a taste test on what's really going on in the economy. But they failed at their first mandate on inflation or price controls. And so their plan is, let's go ahead and destroy the second mandate, which is full employment, and put us into a recession. I don't fully understand it. And remember, this is the Fed that 18 months ago said no inflation, transitory longer, forget we ever said transitory. And then in January, oh my God, there really is inflation, but we're not going to do anything. There's no meeting in February. Let's hope it all goes away by March. And then they go into 6 rate hikes.
Yeah, and I remember interviewing you long before, when the Fed was saying it's transitory, it was not, and you were early on saying, no, this is not transitory. Right? What are you doing?
Yeah, it's, my forecast at the end of last year was that we would see a 4% 10-year treasury by the end of this year. And people said, oh, you're crazy. And I said, well, I am, but I'm also right. And my forecast now is I think we can come dangerously close to a 5% 10-year treasury, despite the head fake on the CPI this morning at, below 8% and the third quarter GDP. We got to remember we got to dissect this stuff and understand what's head faking and influencing that isn't going to be there the rest of the year.
Yeah. And we're in a bit of pricing discovery, and it varies really for the different property types, obviously in the classes and locations. But when you think of the value of commercial real estate with these type of rate hikes, what would you tell us?
That's where you need to be doing your forward homework, because the lending environment, you got to understand what the Fed is really telling the lending environment. They're saying quit lending because it's inflationary. So I'm hearing from client after client where deals that are set to close within 30 days that have commitments and the banks are pulling out on them. So we got to understand that's the mindset that if you lend money, that's stimulating the economy, and the Fed says, don't do that. It's like a Seinfeld episode. No debt for anybody will shut inflation down. And that won't work. So I think that's the real concern. If you look at what's happened, there's 2 steps that happen in this process. Step 1 has been happening. So expenses are growing at 2 to 3 times rent growth. And so when you have that and you got an apartment property that's 40% expense ratio, your NOI goes down, same cap rate, you're about a 10% loss of value. That's already happening. That's what we're seeing happen. Step 2 is now you got to go and close on that loan, or you got to bring your capital in, or you got to buy a deal. And you look at a 3% 10-year treasury and now maybe a 4.5% to 5% 10-year treasury. That cost, when you do a band of investments, say, okay, what does that cost structure, capital structure do to my value? It's about a 25% hit. It's not happening yet. That's what's going to play out next year. So you put the 10% with the 25%, and that's how we end up with a third loss in commercial values.
So if the Fed is messaging to the big banks to to slow down or control debt, and the banks actually do it. It's seemingly to me, as a broker looking at it, that the banks would be creating and the Fed their own problem with their own assets, because they're potentially reducing the value of the properties that they have existing loans on.
No, you're applying common sense to monetary policy in a central bank that is 99.9% academics that never made a loan, broke a loan, fixed a loan, transacted a property at all. They don't connect these dots like we do in the industry, and that is a legitimate concern. And it's, I'm hearing from, just look at the bank earnings and how many of them have said what's going on, how even they're seeing investment banking activity slow at the Wall Street banks. The commercial banks, just look at here in our Southeast region. I can give you any number of that have said, don't call me until mid next year. We are closed. And that's community, that's regional, you name it. So it's playing out very much so right now.
Are we in a recession?
Absolutely. So, I was fully confident in that the first 2 quarters we had negative GDP, and then we get this third quarter GDP that said, oh no, it's all over with. We're up 2.6%. And I always look at common sense. When Austin Goolsbee says, keep your seatbelt on, what happened in third quarter, we had 3 things that nobody, including me, really connected the dots to. So the first thing is the Strategic Petroleum Reserve releases were accretive to GDP. So we did 190 million barrels of oil into the market. We didn't have that in first and second quarter. So we brought energy prices way down. So that's new economic activity. Second thing we had is we had massive defense spending to help Ukraine. So does that continue? But that wasn't in there in the first and second quarter. And the third thing is we all discovered Europe's on sale and the dollar's strong. So let's all go to Europe for vacation. You take those 3 things out, we're in negative GDP. And I don't see anything that suggests to me that we'll see a fourth quarter positive GDP or next year. I think we're in tough shape.
Well, would you call the Fed so they quit raising rates? So then we're already there. We're already in a recession.
I think they have a shoot on site order if I get near 10th and Peachtree. Bostic is not a fan.
Yeah.
But he's wrong.
It seems like, if we could get oil and gas prices down, it seems like to me that impacts inflation almost in most products. Most products are delivered right. Is there some semblance of reality there? And what do you expect for oil and gas prices moving forward?
Yeah, so I think we saw our come down with the SPR releases and bringing it down $1 a gallon. We're heading into the winter. We're seeing how severe the supply disruption is going to be in Europe and how much our stuff they're going to need. So highest bidder drives the price. So I think we go back to over $100 a barrel here by the end of the year and well above that into the first of the year. The other thing that concerns me is most of us heard of, Davos, Switzerland. They have the big economic meetings. And so there's also a Davos of the desert. It's where all the oil producing countries meet. They recently had a meeting, and the Saudi prince is very upset at the U.S. for doing this SPR releases and manipulating oil price. Can you imagine that? One of the OPEC members is upset that we are manipulating oil prices. And he had this dire warning to us. And he said, "It is my profound duty to make it clear to the world that losing emergency stock," he's speaking to us with our SPR, "may become painful in the months to come. Running out of capacity has a much deeper cost than what people can imagine." That statement, that keynote speech was not covered by the national media. And in my mind, I said, that's the equivalent of the 1973 Arab oil embargo. We better pay attention. Energy prices are not going down, they're going up.
It sounds like a threat.
It was. I think absolutely, and not one of the national media would cover that speech.
Yeah, and so it's amazing. So a lot of people feel that, if we can produce more oil in the U.S. and that would help the matter, but we just had the midterm elections. Is it going to happen?
Yeah, I don't think so. Unfortunately, so in here in Georgia, you have to go through another 4 weeks of political advertising that, in my opinion, regardless of what side you're on, you probably couldn't have surfaced 2 weaker candidates to lead, our economy in our state here in Georgia. But it's sad, but I don't know. We basically will end up back about where we were. We, 1 seat swing. And again, Georgia determining the power of the Senate, looks like. Yeah.
So no oil independence for the U.S. coming.
I don't see it. I don't see this administration. I don't see the Senate being able to get through Senate a new energy bill. When I speak down in Texas, I tell all the Texans, to keep fracking, to keep that Colonial Pipeline going, and that if those at the end, the northern end of the Colonial Pipeline don't behave, like Pennsylvania, just shut them off. The rest of us will be very grateful for that oil.
So this Saudi threat, if you will call it that, with related to oil. Can you send that to Biden and the crew? Let them know, hey, we might need to open up some oil capacity here in the U.S.
Are you ready for this? Biden was there in attendance.
Oh, okay.
And totally clueless. I don't know if they forgot to put it on his cue card in his pocket or whether he was taking a nap because of the time zone, but he was in attendance and no comment from the White House. No question from the press corps.
Interesting. And part of the economy has to do with the supply chain and what's going on there. What do you see moving forward there? What's going on?
So it's exciting. So I've been advocating for a long time, even before COVID, that we were remaking our supply chain from a California West Coast concentric model from LA Long Beach to Chicago and the rest of the East Coast to more of a north-south, because that's where all but one of our railroads move. It's where most of our ports are that are upgraded. And so if you remember last Christmas, we saw over 100 ships backlogged to the port of LA Long Beach. Guess how many were backed up this past week?
Many.
4.
Wow.
And guess where most of those ships went? They're coming here to our Gulf and our Southeast ports. So the Port of Savannah, there are 22 ports in the Atlanta Fed Reserve District. So if you go from New Orleans all the way around to Savannah and Brunswick, 22 ports. Guess how much research and reports they produce? Zip. It's no wonder the Fed missed the supply chain. And they have more ports than any other Fed district. San Francisco's number 2. And so guess what we're seeing at Savannah right now? We've been seeing over the summer over 40 ships backlogged to unload. Those extra 30 from the 10 that used to be there, those 30 all were calling on LA and Long Beach 6 months ago. So we're seeing this whole supply chain move. You got the Gulf Coast, you got Mobile, you got Port Freeport in Texas that can move and connect all the railroads. And we've got Savannah, Brunswick, and Charleston Charleston's the fastest growing. And here's the other thing that's happened. LA Long Beach is no longer the busiest container port in North America. It's New York, and followed by Savannah. So we on the East Coast have already overtaken and displaced the West Coast. So this is, if you're in the East and you're in the South and you need supply chain and you need supply chain infrastructure, we're the place you need to come.
Yeah. Interesting. One of the things that impacts the economy is the consumer spending, right? In the U.S., we like to spend our money. And of course, the e-commerce is growing. What do you think about consumer confidence when you look at what's going on in e-commerce today?
Yeah, so 2 neat things. Well, neat. It's unfortunate. So if you look at the University of Michigan and its consumer confidence, which is the longer than the Conference Board. So their all-time low in consumer confidence was in 1980, and it hit like 23. It hit an even lower number this past June. So consumer is really bad. It's bounced back a little bit over the summer because energy prices came down, but that's going away after the SPR releases stop. But here's the new metric I stumbled onto trying to figure out the Amazon effect and always looking in there. So there's a little retail company many of you may know called Coresight. They just do incredible primary research. The Fed ought to have them on their, FOMC, pre-FOMC meeting. And so they started studying what are consumers doing with their cart in e-commerce. So the normal cancellation rate was about 10%. So think you got to go find the good, you got to get the coupon, you got all your information and credit card in there. It's about 20 minutes, maybe 40 minutes if you're like me that's over 60. So you get all that in there, and the cancellation rate has been about 10%. Guess what it was the past 90 days? 75%.
Whoa.
So the consumer is really rethinking hitting the button and purchasing that cart stuff in their e-commerce. And to me, that is one heck of a forward-looking indicator that we better be concerned about.
Yeah. That is surprising. One of the sectors that seems to be most in question these days is the office sector. What do you think about the office sector moving forward?
So when I go to the varsity and they say, what do you have? Office is never on the menu. So here's a story on office. The key indicator I look at is the Castle system that invented all the technology for our key cards to go in and out of the office. And they've been telling us not even half of us are going back to the office. And then we're getting reports out of Pension Age and NACREIF that are telling us the pension funds are saying, we've already lost 10 to 20% of value. We don't want to lose 40. Let's start liquidating these assets. So I'm getting a lot more calls from big funds and whatnot saying, what's the price? What's the value? What should we do? So Castle System is telling us half aren't going back to work. I think the model is that we will use office, but in different ways. And I don't think we're going to use office in the big urban CD markets. It's going to be suburban. And the suburban office is very strong. It's many chunks of small space that I can lease as a company for my employees to have team meetings or to meet with a client, but none of them want to go downtown. None of them want to do public transportation. And I'm paying too much for it. And if I got to cut costs, I'm going to cut it. So I'm very bearish on urban CBD high-rise office, but the suburban mid-rise type stuff, I'm very bullish on. Just for you.
Yeah, thank you. Well, when you look at the market and you look at interest rates today and where they are, some folks in our industry have only been in it for 10 or so years, and they've had really low rates and strong growth. What would you say to those folks who, when we look at today's interest rates and look kind of historically at interest rates in the market?
So go back and study a little bit of history. So when you look at the 70s and 80s, when we went to, by 1981, a 21% prime, my dad was a ski resort developer. I don't know how he functioned and how we did business. I remember my first mortgage in Phoenix was 10.5%. He said, take it. It'll never be below 10%. So we've been spoiled on cheap capital. And this is compliments of the Fed. And they didn't do the connect the dots research to figure out how do you ever unwind all this free money supply. And so we're going to see things that I think a 10-year treasury or, interest rates that are in a 5 to 7 is pretty decent. It's a new norm, but we're not prepared for that. And so we're leveraged up. We're used to free money, and we're going to find that we're going to need more equity in deals. We're going to have to renegotiate with the banks. If they don't want a complete loan loss on a building, they're going to have to negotiate. They're not there yet. And so I think we're also going to have to look at things like the auto industry. So look what happens when interest rates go up and how the auto industry responds. They buy down the interest rate, make it think like you're still getting a 1 or 2%, loan on the car, but they put it on the back end. It's all about the payment. So we're going to see everything in commercial real estate and finance go back to the payment and not so much the value of the asset. And so figure out how that works.
Yeah, interesting. And, there seems to be a lot of liquidity, a lot of money out there for commercial real estate. And if there's less buyers in the market and there's a slowdown in activity, I guess for some buyers that like to buy cash, it could be an opportunity, especially if you're looking at real estate kind of as long-term hold, right?
Absolutely. We got to go dust off our original appraisal classes about this thing called the principle of substitution. So in an inflationary environment like this, the next of anything that you buy or build is going to cost more. So the long-term investor gets that. And they say, okay, if we're seeing construction costs and everything go up 10, 15% a year, getting this building today over 2-3 years, I'm getting it a quarter to a third off. So they understand the principle of substitution, and they do a replacement cost estimate to see where they are in that deal. I think the second thing, that goes on here is that we're seeing different capital sources come in from around the world. So Vietnam, South Korea, United Arab Emirates. So I was just on a call on a program a couple of weeks ago where the UAE says, we want no leverage. We'll just pay cash. We can do it fast. We can offer certainty of closure, and we're very realistic on where we are. We want to get the best assets that everybody's throwing out. So look beyond. I think our domestic pension funds, our banks, they're all locking up. So where do you go to get that capital? And equity may actually come out being cheaper than our debt capital here next year.
Yeah. Well, it's interesting if you're looking at a long-term hold typically for commercial real estate, and if there's less buyers in the market, if because of higher interest rates, you're getting a lower cap rate. A higher cap rate, you're paying you're getting a higher cap rate, right? A lower price. You're at a lower price per square foot, right? And if you're doing a long-term hold, I know I've got some properties that I've owned a long time, and when I look at it, it's like, well, what did I pay per square foot for it? The cap rate at the time and the interest rate at the time doesn't seem to have as much bearing on a long-term hold, right?
Yep. So as I am a scarred multi-generation MAI, my dad taught me, go get your MAI so you can learn how to manipulate value, whether you're a buyer, seller, or lender. Yeah. And he was right from the perspective of there's a reason we do 3 approaches to value. Yeah. So the pure cost approach, it tells us, where am I in replacement costs? Am I up too high? Am I down too low? So we've been way too high. Now we're coming back low. So it helps you put that in perspective. That cash buyer gets it. We then do an income approach. That's what we most rely on because we're trying to figure out the income. What happens when vacancy goes up and rents are, you don't know what they are and you don't know what the cap rate is. You don't know where it's going. So the income approach becomes less reliable. So then I go back and I look at the sales comparison. So who are the active participants? Is there equity? There are different entities out there than we've been dealing with. They're telling us where they're willing to go between that, maybe high replacement costs, and the income approach where I have no certainty or definition where I'm going. So really, I think go back to the discipline of forcing all three of them. The last thing I tell all my appraiser buddies, they're not all supposed to come out the same number. Reconciliation isn't forcing that. They should be a diverse range there, because the cost approach is just dealing with the sticks and bricks in the land. The income approach is dealing with a lot of other stuff and leases that you may value, intangibles, going concern. And so they should be a range there, but you should understand why there's that range. And then the sales comparison approach tells you where the market's performing.
Yeah. We're seeing as brokers selling commercial properties in the Southeast, we're seeing some buyers come back in the market that didn't want to buy at 4 caps, right? And now they're seeing higher cap rates and they're back in the market. So there are buyers out there and we're seeing activity. So I think the price discovery is underway, right? Where do you think there are some opportunities for investors in commercial real estate today?
That's a really good question. So I'm more bullish on the secondary markets and the suburbs. We've waited a long time. I've lived in the suburbs in Atlanta for almost 40 years, and I've been waiting for it to be on fire and I not have to go, downtown. But the secondary markets, you look at Huntsville, Alabama, you look at even a Gainesville, Florida, you look at a Mobile or a Montgomery, where they just got the inland port to support their port. The secondary markets are on fire, and if you look and follow site selection, where is Toyota, Mazda, VinFast, all the EV manufacturers, where are they going? They're going to secondary markets. They're not, because they need the workforce. It's affordable, and they're really coming to more of a southern direction. So I love the secondary markets. And then the suburbs, because I think this is as much a watershed event as when the GIs came home from World War II. And they said, we're not going to come back and live with mom and dad in the country club neighborhood. We're going to go out and create this thing called a suburb and a regional mall, and that's what's going to be the driving force for commercial real estate for the next 4 decades. I think we're in something like that, but it's in a reverse and different things. The millennial workforce, the young workforce, even people like myself, Michael, don't tell anybody this. I really don't want to go back to the office. I love working remote. My office is usually a Delta Crown room at an airport somewhere. Yeah. And when you look at all that overhead and that cost, unless I'm in small chunks in the suburbs where I got to meet, I've got to interface, I got to have a team meeting, that's what works. And the big downtown office building doesn't. Yeah.
And, and I think there's a lot of professions similar to yours where that does make sense and you don't need it. I mean, your team is kind of spread out anyway. You travel a lot, speaking around the world and dealing with clients, around the country, right, and around the world. But I'm really I think office does come back, and I said this last week on the show, but I have the solution for the world.
All right.
If anybody would ever listen to me, they wouldn't. But to the work from home, remote, and I think there are a lot of benefits for employees to be together and learn from the older people, learn from the younger people, and the collaboration. And I think for the companies, the cybersecurity, the trade secrets, the onboarding, the having a sense of belonging, and all the benefits. And I think some companies are having that push and pull where they'd like to have folks back for all the benefits of their employees and the employer. And some employees are like, you know what, maybe the office is okay, but I certainly don't want to do the commute. Right? I don't want to do the commute. So I have the solution. Let's go to a 4-day week.
There you go.
Let's go. Monday through Thursday.
That's what the Fed does. That's why they miss, 25% of what's going on in the economy.
Well, I think, I read the other day that it seemed like the article was surprised that employee production is down. I'm like, what? Are you kidding me? Why is that surprising?
Yeah.
When I don't like working at home, I love working at the office. But when I did work at home, there's distractions. There's the refrigerator, there's the dog, there's the family, there's the toys and the TV and Netflix and I love these employee surveys. When they survey employees, and 90% of them say they're more productive at home. Well, here's the challenge. Netflix says the opposite.
You know who else says it? So the Castle system, they started tracking, instead of just their back to work barometer, they all now are tracking what we're doing when we're not at the office. And so we are back to 100%, almost 100% of going to NBA games, going to college activities, going out to restaurants, travel. We're doing everything but work, at 90 to 100% of what we did before COVID. The other one, though, I think you're onto something. So you've probably heard the acronym FOMO, fear of missing out.
Yep.
And our young workforce, and we've had it with our own, have said, you can do so much, only so much on a Zoom or whatnot. But, to be able to be working on an issue and I can pick up and I can go down to your office and have you walk me through and spend a little bit extra time rather than trying to schedule a Zoom meeting, it's huge. And we know the acronym in our industry, out of sight, out of mind, there's no promotion for you. So I think the young workforce is who I'm hearing from is saying we probably need to get back, but they don't want to do the commute. They don't want the cost, but they're saying the employees, our middle ground is get me into the suburbs near where I live.
Yeah. KC, what would you leave our audience with to think about commercial real estate and the economy moving forward? Here we are at November of 2022.
So what we're going through now is what we were supposed to go through a year ago. Most of us had our best years ever, and it didn't make sense. This is the unintended consequence of bad FOMC policy. When you put almost $20 trillion in the economy, $9 trillion from the Fed, and another $12 trillion from Congress, you just don't sop that up and not have inflation. So they didn't connect the dots. So what we're going through now is what we should have gone through a year ago. Number two is that the best performing asset of the three classes, equities, bonds, and real estate, through every recession, commercial real estate powers through. You get a coupon paid on someone paying rent, and the next one in an inflationary environment costs more to buy or build. So if you entered the 70s with real estate, you exited in the 80s pretty wealthy and did very well for the next. So don't give up on real estate. As tough as it seems, we'll be there. Jimmy Buffett had an album cover that said, if it's tough, breathe in, breathe out, but just keep moving on, right? And Yogi Berra said, you can learn a lot just by observing. And what we're going to go through, observe with peers, observe with people like you and me, where maybe our hair won't make it through another recession. I know mine, it's 3 or 4 ones, it might not. The last thing I would say very seriously, our number one challenge we're going to face is capital for our industry. We are a capital intensive industry. We thrive when we have good affordable debt and we die when we don't. And so you need to be looking at when things are maturing, when things are callable, who is still in the market, because a lot of the banks right now, if you read their earnings, you read what they're telling you, what they're saying is we're essentially being told by the Fed not to lend because lending is inflationary. And so they're contracting all of their commitments and saying, maybe talk to us mid-next year. So again, the value of community banking relationships, the value of credit unions that do lending, we're going to have to think capital in a different structure. And you're going to have to do more pencil work to figure out, how do I make this deal work when it worked at a 4.5 to 5 cap rate because I had a 3% 10-year treasury, and now it doesn't work other than maybe a 7 to 8 cap rate when we're at a 4.5 to 5% 10-year treasury. A lot of elbow grease is going to be done around the capital side, and I think those that hadn't been around even 15, 20 years are going to learn some lessons. Hang around with people like yourself or me. We'll help you figure it out. Good advice. Well said, KC. Great information. Thank you for joining us, sir. Appreciate it. All right, and thank you for joining us around the country. Hey, we'd like to know what you think. Feel free to reach out to us by email, social media. There's this other thing that I sometimes hear people using, actual telephone. You can actually call. So reach out to us anytime you want, and thank you for joining us. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Buxton. Take leasing, site selection, and due diligence to the next level. Make the right decisions with on-demand mobile data. Visit buxtonco.com. By Bull Realty. For proven commercial real estate asset and occupancy solutions, contact me. My email is michael@bullrealty.com. By Commercial Agent Success. Expert-level commercial real estate broker training. Cloud Access 1, up to 21 one-hour videos. Visit commercialagentsuccess.com. Thank you for reviewing, subscribing, and sharing America's Commercial Real Estate Show.